Welcome to a session on share-based payment, IFRS 2, which regulates compensation of employees through share-based options. IFRS 2 applies to all share-based payment transactions, which are divided into three. The first one being equity-settled share-based payments. Under equity-settled share-based payments, the entity receives goods or services as consideration for equity instruments of the entity. The second one is cash-settled share-based payments. Under this one, the entity acquires goods or services by incurring liabilities to the supplier for those goods or services for amounts that are based on the price of the entity's shares or other equity instruments. The third one is transactions with the choice of settlement. Under this one, the entity receives or acquires goods or services in the terms of the arrangement provide either the entity or the supplier with the choice of whether the entity settles the transactions in cash or by issuing equity instruments. As with all standards, we'll first start with the recognition criteria. An entity needs to recognize an expense for the services rendered by the employees during the period in which the shares have been offered, the period known as the vesting period. So the first we have to recognize an expense or debit expense at the year end. What we credit will depend on what the equity instruments, what the option instruments offered are. If the instrument, the compensation is through equity, then we'll credit equity. However, the credit does not go to equity, it goes to OCE, other components of equity, where it will sit until the employees have exercised the option. If the compensation is cash, then we'll credit the liability until the vesting period, and the employees exercise the option and they're paid the cash. After recognition, we move to measurements. Under measurements, there are two methods. The first method is the direct method. Under the direct method, we use the fair value of goods or services settled. Then we also have the indirect method. The indirect method is the one which is most popular in the exam. Under the indirect method, this applies often to employee services. Here the compensation is referenced to the fair value of the equity instruments granted. There are two methods, like we stated. The equity settled, we use a fair value at grant date and we do not restate or update for subsequent changes at the year end. For cash settled, we use a fair value at the end of each year, and any changes in fair value at the end of each year are recognized in profit and loss. We'll now look at an example question. In this question, an entity grants 100 share options on its $1 shares to each of its 500 employees. We are required to show the entries over a 3-year period in the event of the following. In the first year, we assume 20 employees will leave during 20x5, and the estimate of total employees departures over the 3-year period is revised to 15% or 75 employees. We always start with the opening balance, which is always 0. Equity brought down is 0. What we compute always is the closing balance. The expense for the year is a balancing figure, so we do not know the expense to take to profit or loss. So we compute the equity carried down, which is the closing balance. We have 500 employees. At the beginning of January, out of these 500 employees, we expect 75 employees to leave or expected to leave. Each employee has been offered 100 share options. These options are fair valued at the beginning of the year, the date of being granted $15. But the condition is that the employees